afternoon, everyone. My name is Jamie Terrell. I lead marketing and communications here at Saltmarsh, and we are happy to welcome you today to part 4 of our webinar series on the Paycheck Protection Program, also known as PPP. Just a reminder, if you've missed any of our previous webinars on this topic or others we've held, you can always find them on our COVID Resource Hub, which you see featured here on our opening slide today. That is saltmarshcpa.com/COVID-19. We have a variety of resources and other articles related to the financial impacts of COVID for you there, so please check that out if you're interested. Joining us again today are 3 members of our own COVID recovery and response team, Suzanne Cox, Glenn Scharf, and Andrew Kent, all shareholders here at Saltmarsh, and we are glad to have them leading our presentation once again today. Before we get started, I do have a few quick housekeeping items to share. First, everyone on the line has been muted. If you have questions during the presentation, feel free to share them with me using our questions feature. We should have some time toward the end for Q&A, so if you'll share your questions with me during the presentation, we'll hold them and address some of them together. You're also welcome to share your questions with us by email to ppp@saltmarshcpa.com, and someone from our team will follow up with you directly. Today's presentation is being recorded, and you'll receive a copy of our presentation and slides tomorrow by email. In that same email, you'll receive a link to complete a short survey. If you've attended our webinars and found them valuable, would like us to keep holding these, please take a moment to share your feedback in that survey. It will really help us to improve these virtual events going forward. We appreciate you taking a moment to do that. And with that, I will pass the mic over to Glenn Scharf, shareholder in our tax and outsourced accounting practice, to get us kicked off today. Glenn?
Thanks, Jamie. Well, welcome everyone to part 4. Some of us can't believe we're on part 4 already, but here we are. Certainly, we've had a lot of changes, and we've tried to keep these webinars as fresh as possible, making sure that A, we're not repeating ourselves too much, and B, that y'all are learning what the latest and greatest are. So our agenda for today, 3 items on the agenda. Our guidance clarification. So we've gotten some interim final rules. We've gotten new applications. So just all those types of things that were going on, changes since the last webinar, and then once again, our hopefully some answers to frequently asked questions as well. So next slide.
Just add to that. Like Glenn mentioned, we've been trying not to do a lot of repetition from one webinar to the next. So if there's something today that we didn't cover that maybe you have questions about, we do have a couple more before this that you can go watch our recording. So we will not be going over, from start to finish today. We're trying not to repeat. This is somewhat of a series for us. So if you've missed something, feel free to go back and check out some of our previous ones.
Thanks, Suzanne. Yeah, and certainly, we'll be monitoring the chat as well in the program. So if you have something specific about what we're going over, we'll try and get some of those at the end if we have some time. So in ancient history, in the COVID world, ancient history is March. So in March 27th, that's when Congress passed the CARES Act and the Paycheck Protection Program began. The PPP loan, once again, is based on 2.5 times your average monthly payroll. And once again, you can be forgiven by, using qualified payroll, rent, mortgage, interest, utilities. We've been all over that before, but over the 8-week period, referred to as the covered period, those are some of the changes that we're going to be talking about today in moving forward. So, that 8-week period now can be even a 24-week period. So, but the only constant we have in this whole thing is that every week we seem to have changes. Hopefully we're at the end of the changes. Most people have gotten their loans. Most people are coming to the end of their quote unquote covered period for the 8-week period. And so, the questions begin of, okay, what are all these changes and what do I do now? And so this is kind of the things that we're going to be going through is, what do I do now? On June 5th, the Paycheck Protection Program Flexibility Act became law. I don't want to say that 3 times fast. But they had basically four main changes. The biggest change that I think everyone has heard about is that the SBA's rule that 75% of loan proceeds had to be used for payroll now is down to 60%, and that 60% now is statutory. So that's in the law. The 75% was never in the law. And so, Congress had to go back and fix it because they were realizing that a lot of people during this 8-week period couldn't spend all of that 75% on loan proceeds. And really the whole premise behind this whole program is to get as many people, forgiven as possible if they're using it in the right place. But they just couldn't use it over the right time. And so that's where these changes have come into play. You've got, once again, an extension of the loan terms. And we're going to go through all these more in detail in what, this is kind of the overview. Next is the extended covered period, the PPP loans. So we I mentioned that 8 to 24 weeks now. And then finally, we're giving rise to new safe harbors, creating more opportunities for everyone to get full forgiveness. So it's really key that the Congress recognizes that were just certain circumstances out there that people could not, continue either their business or their business operations, or for one thing or another. I mean, I don't think when they created this original law back in April that they predicted, all these shutdowns and different, industries being affected and things like that. And so those are the types of things that we're going to be discussing today. So I'm going to go to the next slide, and Suzanne is going to take over and go through some of the details.
Sure. So one of the changes that we talked about on our last webinar was that if you had received your SBA loan on or before a certain date, it was originally a 2-year period. And so they have extended that to a 5-year period. So if you received your SBA loan on or after June 5th, that loan will automatically be a 5-year maturity. If you got your loan on or before that, it would be a 2-year maturity. So, or just before that, not on or before. One thing to note here is that the borrower and the lender can agree to extend to 5. So if you had your loan before June 5th and you talk to your lender, you can extend that to 5 years. And just another thing to remind everyone here, is to get in contact with your lender, be in constant communication about when their portals are opening. What will the terms of your specific loan be? Do you want to negotiate different terms? Again, if you had a 2-year loan and you'd like a 5-year loan, you need to agree to that with your lender, and they need to approve that. It's not automatic that it went to 5 years. So again, just be in contact with your lender and make sure that you guys are communicating. We've had one of the questions we've gotten is my lender isn't ready, their online portal isn't ready. And we've read from some banks that they are not accepting paper applications. So you can't just, FedEx it out and call it a done day. So it depends on the lender, and we don't know what all of the lender requirements are. So, please get in touch with your lender.
Yeah, I know that too, Suzanne, I know that 2 banks, I think we looked at Wells Fargo, and then I've gotten some information from Trustmark. They're only doing, the online applications. I would imagine that most of the bigger banks are going to follow that. So if you're with a bigger bank, they're going to do it all online. The smaller banks, the local banks, they may have more of a manual process. But as we'll go through some of the, how the process works later, it shouldn't matter whether you file electronically or by paper. So.
Yeah, I'm hearing most are electronic as well. So obviously for them, it makes it a little easier. So as Glenn mentioned early on here, some of the changes in the last couple weeks and our last webinar specifically is the extension of the covered period. And so initially, if you got your loan again before that date, you had an 8-week period and that was it. And as of June, they changed that to a 24-week period. So there's been a lot of questions surrounding that. Do I get to pick 8? Do I get to pick 24? What if I finish my funds in 10? And so there's a lot of questions around here. Probably the main question that we've been having is, which one do I pick and how do I make that decision? So we're going to talk a little bit about that in depth here today. It's, there's just too many choices. So there are some strategies to consider here, and what does that look like for your individual company? So again, this is the biggest question. And the one thing that has changed from our last webinar that's very important that we're going to talk about a lot today is, as of our last webinar, you only had 2 choices. You had 8 or you had 24. There was no 10 or 11 or what if I run out of money? You had to pick one of those 2, but they have issued in the last IFR here, as you can see the language in the second bullet point, is that the borrower may submit their application at any time as soon as they run out of money. So when can you file? When you don't have any more money. So we're going to talk a little bit more into detail, but that's one of the, the main things here. And so what do you have to consider if you want to pick 10 or 8 or again 24? So have you used all of your expenses? Did you run out of money? Did you have a reduction in salaries or FTEs or hourly wages? Have they been restored, or do you need more time to restore those? And we're going to get into the safe harbor calculations a little bit, and so you can understand, exactly what that means. Do you foresee having to make future reductions? So if you are, right now at your 8 weeks and you're fully staffed, you have not let go of any people, but maybe you have 2 weeks left before you run out of money. Maybe you hang on to those people for 2 more weeks until you run out of money and then you file. You don't want to let those people go before that, because then you would have a reduction in FTEs. Or perhaps you are needing to reduce salaries due to cash flow issues. Things are starting to, roll back a little bit, and some restaurants and bars are having to, reduce and close in some instances. And so maybe for that situation, you would want to, file now while you still have people employed, and the future is somewhat unknown. And so again, these are all the questions that you need to consider. And then the other one that we talked about a lot in the last webinar as well, but just want to make sure that everyone understands is, this process could take a significant amount of time. The lenders have 60 days and the SBA have 90 days. And so this could push you out, possibly into a next year situation. I know right now we're ramping up for a lot of our 630 interim audit and compilations and so forth. And so this is an outstanding piece of debt on the books of a lot of our clients. And so until you get that final forgiveness piece, until the bank says, here's what we're going to forgive for you, this is an actual liability on your balance sheet. And so it may affect some loan covenants and some other things that you may not anticipate. So, consider this if you're going to roll into 2021. This, could possibly affect some of your debt covenants or other issues with your financial statements. And so, I'm sorry, go ahead.
No, hey, Suzanne, and hello to our audience out there. This is Andrew. I just want to point out, that is something that I think a lot of people, it's kind of one of those sneaky little things. Obviously, what we put out here is a worst case scenario. We know that the SBA is going to have 90 days. We know that lenders will have up to 60 days. So that means, if you haven't filed for forgiveness by the end of July, you could potentially be looking at a decision that doesn't occur until after the 1st of 2021. And so there are lots of, like Suzanne just mentioned, contractors who have loan, or any business that has loan covenants or bonding requirements, professional firms that, need to figure out and make, distributions to owners. What kind of cash do you have available? These are all, decisions that can be impacted by whether or not this loan gets forgiven. And so, just something to keep in mind. We're not necessarily saying that, it's very possible you could file for forgiveness in September or October and have a decision before the end of the year, but it's also very possible that, between the SBA and your lender, they could take the full 5 months.
Yeah, and I would just say on that, it also depends on the size of your loan, I would think. So for example, if you're greater than a $2 million loan, the SBA has already come back and said, hey, we're gonna look at this hard. And so that's obviously gonna take longer than, if you had a $20,000 loan. So, just anticipate that a little bit more, I think, on the longer end. for larger loans, I would think. It's just my opinion.
Yep. No, and the other thing I'll point out real quick is that, a lot of these decisions are being driven, and this is something we talked about a lot in the last webinar, but just for those on the call that may not have been with us last time, a lot of these decisions and a lot of these issues are being driven by the fact you've still got a loan that's based on essentially 10 weeks of payroll. It's 2.5 times your average monthly payroll in 2019. But with the PPPFA, the Flexibility Act, you've now got up to a 24-week period to use that payroll. And so a lot of the tests and a lot of the mechanisms that they put in place that made sense with an 8-week covered period start to not break down a little bit, but become more problematic when you're looking at that same, the amount of dollars you received didn't change, but the period tripled. So anyway.
And we're going to get into a little bit more detail here, but just throwing out an example. If you have reduced salaries and you aren't going to restore them, you have no plans to restore them, and you run out of money, you may want to go ahead and file now. But if you reduce salaries but you intend on restoring them, that might be a situation where you decide to wait a little bit longer, and we'll get into why in a second. But those are the kind of things you need to be, discussing and thinking about. And so today, one of the things we're going to talk about, which again changed from the last webinar, is the filing early, or this new covered period. So initially it was 8 or 24, it was pretty black and white, and now it could be 10 if you run out of money at 10 or you run out of money at 12. And so some of the language has not included that is the end of the covered period. And so we always like to tell you guys things that we know and things that we're not sure about. And so this is one of the things that we're not 100% sure on, and we are hoping that further guidance will clarify this. And so we are making the assumption today on this webinar that if you file at the end of 10 weeks, that your covered period ends at the end of 10 weeks. Again, that's an assumption, and just want to make sure that you guys are clear that, hopefully further guidance will clear that up for us. Some of the guidance has been defined as the date of the application, the date of the application, that's the end of your covered period. But then there's some part of the guidance that doesn't say that. So again, we always like to be clear on where we're making some assumptions, and that is an assumption that we're making for today. So Suzanne, I'm going to pass this over. I'm sorry, was there something else to add there?
No, just on that slide real quick before we leave. I mean, I think it is worth pointing out, and I know we talked about this a number of times on the last webinar as well, but that the term covered period is used all throughout both the original CARES Act, the Payroll Protection Program, authorizing statute, the forgiveness statute, the guidance, and I mean, for example, there's a covered period that deals with eligibility for PPP loans, and then there's a covered period as it deals with forgiveness of your PPP loan. And as Suzanne was just pointing out, we've got guidance that specifically modifies that covered period language and says, it's as of, for example, December 31st, or the date your application for forgiveness is filed. But then there are lots of uses of the term covered period where that distinction is not made. And so that's what we're pointing out. There's still, in some of these calculations, some of these areas, there is a lack of clarity here. So Suzanne, I think I've got the next one, so you can go on to the next slide. All right. So the salary and hourly wage reduction test. So this is, there are a couple of tests, or a couple of, you've got your basic forgiveness calculation, which is your loan amount minus your, minus your eligible expenses. But then there are a couple of factors that can reduce how much forgiveness you're eligible for. And one of those is a reduction in your forgiveness based on a reduction in salary or hourly wages. So this test measures salaries and hourly wages during the covered period and compares them to the average compensation for the period from January 1st, 2020 through March, I think that's supposed to be 31st, 2020. And so essentially what you're doing is you're saying, if you reduce salaries or wages by more than 25%, then then you're gonna start to have an impact to your forgiveness. It's one thing that's clear, and so once again, that even though you can file early, so you may be in a 24-week covered period, you may choose to file at week 10 or week 12 once your payroll, your PPP loan funds are exhausted. For example, when you actually go to apply this test and run the calculations, you have to take into account the full 8-week or 24-week covered period. So does that mean you have to actually wait the entire 24 weeks? We certainly think that if you meet one of the safe harbors, then the answer is no. If you don't meet the safe harbors, then there is a little bit of gray. We're back in one of those little gray areas, because in the answer may be that you do have to wait in order to run some of those calculations. But we're going to talk more about the calculations in just a few minutes. So Suzanne, the next slide. So the salary and hourly wage safe harbor. So this is a key element. So once again, there are a number of steps, or a number of decisions that take place here that involve, do you meet the safe harbor requirement? And by safe harbor, what we mean is it's a formula or a test that says you don't need to worry about your forgiveness being reduced by this calculation. And so the salary and hourly wage safe harbor takes your average salary or hourly wage paid during your covered period. So it's the average, either salary or hourly wage paid during the covered period, and compares it to the average from 1/1/20 through 3/31/20. And then if you apply the safe harbor test, determine if reduction was remedied, and you apply that safe harbor based on the earlier of December 31st, 2020, or the date that the application for forgiveness was submitted. So this is one of those things where the regs, or the interim final rule, has clarified for us that it is you run the test based on the date that your application for forgiveness is submitted. So that can be a little challenging, because you're going to go through a process to prepare your application and then actually submit it to your lender, and the trigger date is the date that it's actually submitted. So Suzanne, next slide.
Yeah, I think that, amongst us, we call this the makeup clause. And, basically Congress, and we're going to go through this example here, we're going to call this, Congress wants us to continue paying people at the same pay rate. And so if you had a reduction, but you make it up later in the year, even if it's after your covered period, then you have time, to make that up without getting a reduction in your wages. So that's another point in, do I want to extend filing if I'm going to pay people more later on, that I might have to wait? Even though I'm out of money, you can still make up with a shortfall that you had before. And so we'll let Andrew go through the example.
Right. Thanks, man. And this is just a very simple example of, when you're looking at the safe harbor, and we're not going to try to get too far in the weeds and bore everybody with a bunch. We're accountants, we love our math, but we're going to try to stay out of that a little bit. But for example, most of you remember, I think, if you've been to one of our other webinars, we have our friendly little company here owned by Dudley Do-Right. Dudley has an hourly employee who was making $10 an hour on February 15th of 2020. And then after February 15th, but before April 26, 2020, and these are trigger dates that are in both the rule and the forgiveness application, Dudley had to reduce this employee's wage down to $6 an hour. So key there is that's a reduction of more than 25%. So that's one of the tests to know if you may have an issue with a salary or wage reduction. If you didn't reduce anybody's comp by more than 25% during the period, and we're not talking about their actual paycheck, we're talking about their rate of compensation. So it's either their annual salary or their hourly wage. There's another reduction that we'll talk about in a few minutes. It deals with the actual number of hours they work. But if you reduce their comp by more than 25%, so $10 to $6 is more than 25%, 40%. So we're in this test now. We got to see if we meet the safe harbor. So at the end of 10 weeks, Dudley's managed to use up all his funds, but he wants to go ahead and file. But the employee is still at $6 an hour. If that's the case, the safe harbor for that employee hasn't been met. And so you're going to have a reduction in forgiveness based on this reduction in comp for this one employee. And that's another key thing about this test, and one of the very complicating things. If you're in a business where you've had to reduce compensation for any employee, it's a per employee test. So you're literally going to have to take this test and run it, by for each person. For a lot of our clients with 10 or 15 or 20 people, or who just didn't have any salary, wage, hour reductions, that's easy. But if you're a manufacturer or in the hospitality industry and you have 200 or 300 employees, this becomes, it's a lot of work then, because you have to run these calculations for every person. So in this instance, Dudley wants to file, he's going to have a salary or hourly wage reduction issue. So what does it take for him to get to the safe harbor? And what it takes for him to get to the safe harbor then is, by the time he files his forgiveness application, or by December 31st, whichever is earlier, Dudley's got to restore that employee's average comp. And so he can't just wait till right before filing and bump him up to back up to $10 an hour and be free and clear. He's got to get him to $10 an hour earlier on, so that over the entire period, January 1 through either the date your application filed or December 31st, his average compensation is back up to the same level that it was on February 15th. And that may even involve needing to pay the employee a bonus or increase their hourly wage above $10 an hour for some period of time in order to get that average hourly comp back up to that February 15th level. Suzanne or Glenn?
This goes a little bit into that strategy that we've been talking about as well. So if you see the outlook, towards the end of the year as being positive, and you don't see that you're going to let go of any more people, and you think that you may be able to restore salaries, that may make sense for your company to wait then and file once you've been able to restore those salaries. So if you are hoping to file early and get it done with, but you're going to take a pretty big hit on the salary and wage reduction here, it may make sense to wait a little bit longer if you see the future as, positive and able to, restore people's salaries to what they were on average, prior to this all coming,
The flip side is our clients in the hospitality industry that are facing, a new round of bar closures here in Florida, or a restaurant, potential reductions in capacity. That's, those individuals could have some potential impact from
Yeah,
this.
on the flip side, I think if you're, looking forward and it may get worse for you, it may be best to cut your losses now and file. So it's very case specific. We hate to say one fits all, because each company is different and industries vary widely as well. So like Jamie said earlier, if you guys have specific questions, we'll be glad to answer them. Just email our PPP. So Andrew's going to continue talking about the next way that you might be reduced is based on your FTE count.
Yep. So next slide. So the FTE reduction quotient. So if you've been in our webinars, you've seen, we've talked about this in the past. I think we had a version of this slide in a prior webinar, but the FTE reduction quotient takes your average FTEs, and when we say FTE, we mean full-time equivalent, and that's a very defined term in the Payroll Protection Program. It's it's basically 40 hours a week is a full-time equivalent. Anything less than 40 becomes a partial or fractional full-time, and nobody can have more than one full-time equivalency. So if you have somebody working 60 hours a week, you don't get 1.5 FTEs for them. So you take your average FTEs for the covered period, or your alternate payroll covered period, and you then divide by the average FTEs for one of your chosen reference periods. So you get to pick your reference periods. You've got a couple that you can choose from, 2/15/19 through 6/30/19, 1/1/2020 through 2/29/2020. Or if you're a seasonal employer, you can pick any 12-week period between 5/1/19 and 9/15/19. Note that the average FTEs are measured over a much longer period than your benchmarks. The quotient then basically what you're doing is you're calculating a ratio. So if you reduced, if your FTEs were 20 and they're now 15, you've had a 25% reduction, and you're going to get essentially a 25% reduction in the amount of forgiveness that you're entitled to. So, and importantly, it applies to the entire forgiveness amount, not just payroll. You do get to exempt certain people from the calculation. So people that that rejected offers to rehire, for-cause terminations or voluntary reductions, you don't have to include those people on either side of the calculation. So you don't have to include them in your benchmark period. You don't have to include them in your covered period. So next slide, Suzanne. All right, so this brings us up then to something we touched on a few minutes ago. You've got what we call the FTE trap, and that's where it goes back to this concept that your loan was based on essentially 10 weeks of payroll, but now if you're in the 24-week period, you've got this, you've got a much longer period to use those funds, and so it's very tempting to then take your funds and try to stretch them out to make them last for the entire 24-week period. And so we used this example, I think, last time a little bit, touched on this, but let's say you have a borrower who has a PPP loan of $30,000, and that's based on 3 full-time employees, all of whom make $1,000 a week. So his total payroll pre-COVID was $3,000 a week. He has 10 weeks of payroll, so he got a loan of $30,000. Under an 8-week covered period, those 3 employees times 8 weeks times $1,000, you'd have $24,000 in forgivable payroll. And you'd have 3 FTEs during the covered period, same as your pre-COVID measure. So no FTE reduction, all's good. You spent $24,000, you got $6,000 left to spend on utilities and rent, mortgage interest. But now under the 24-week period, looking ahead, now you say, well, I need to stretch those funds out. I'm concerned about what's going on. So you lay a person off, you cut the other 2 down to 50% time, and you get the same payroll. You've got 2 people working 24 weeks at $500 a week. You got the same $24,000 in forgivable payroll, but now you've just got 1 FTE. And unless you can meet one of the safe harbors, your forgiveness is reduced by 2/3. And so this is where the new safe harbors come into play. And so Suzanne, you want to, next slide. So this first safe harbor here is the new one that came out with the PPP FA, and that's if the borrower is unable to operate at pre-COVID levels between 2/15/20 and the end of the covered period, based directly or indirectly on guidance from HHS, CDC, or OSHA. And so the reason why we're revisiting this one now is because since our last webinar, we have gotten some more guidance on this issue. Not a ton of guidance, but we've gotten a little more guidance and a little more clarity here. And one of those, for example, is that the language directly or indirectly. So a lot of our clients and a lot of our viewers out there have been impacted. The CDC did not close your business, or the CDC has not restricted your activity. But for example, the state of Florida, the governor of the state of Florida may have issued an executive order restricting occupancy in restaurants or even closing restaurants altogether based on recommendations from OSHA or the CDC or HHS. And so that's where the directly or indirectly comes in. So you can have had your business closed, even indirectly if you're closed by a local authority who cites back to the CDC or to OSHA, then that is that indirect reliance on the guidance. And it does appear, one of our questions I think from last time was, did you have to be shut down, or did this guidance have to be in place for the entire covered period? In other words, were you subject to this for the entire 24 weeks? And based on the guidance that's come out in the interim, it appears that if you were impacted by one of these rules at any point during the covered period, so if your business or if your business activity was reduced at any point during the covered period by per one of these orders, you are essentially able to then take advantage of the safe harbor. And this is key because meeting the safe harbor will get a lot of borrowers into, for example, something we'll talk about in a minute, the ability to use the new easy forgiveness application. So this safe harbor could potentially greatly simplify your forgiveness application process. The second safe harbor is the one that's been there. And Suzanne, if you go back to the other slide for just a second.
Sorry.
No, the second safe harbor is one that's been there before. It was just modified by the PPP FA. And that's if you had a reduction in your FTEs between 2/15/20 and 4/26/20 as compared to 2/15/20, and then you restore the FTEs on or before the earlier of the forgiveness application date, which is now either the forgiveness application date or December 31st. In the prior version of the law, it was simply June 30th. Then you meet that safe harbor. And the key thing here is that unlike the salary and wage reduction safe harbor, where you're looking at an average salary or hourly wage prior to your forgiveness application or December 31st, here it's measured on the day of. So you're not looking at average FTEs. As long as you restored those FTEs by either the date of your forgiveness application or December 31st, it appears that you will meet the safe harbor. So now, Suzanne, we can hop forward real quick. Or do you going to have any comments on this?
Yeah, just to reiterate that, I think that there is a difference. I know you just said it, but just double reiterate is that the salary and wage reduction test is an average, and the FTE test. So again, back to our example of Dudley and his one employee, he can't just change his wage back to $10 the day before, his end of his period. But in the case of FTEs, you could hire back someone on the last day before the end of your period and still meet this safe harbor test. And so I think that's just really important to remember that they are different. You can't just jack up salaries at the last minute, but you could hire additional people at the last minute and still meet that safe harbor test.
Yeah, good point. All right, so now next slide. So this is just, we won't spend much time on this. This is a very simple example of how the FTE safe harbor calculation works. So step one is you calculate your average FTEs between 2/15 and 4/26. Let's say in this example that you had 8 FTEs during that period. Then step two is you calculate your FTEs for the pay period inclusive of 2/15. So the first step is you're looking at FTEs over a period of time. Step two, you're taking FTEs for one snapshot in time, the pay period that includes 2/15/20. And so let's say you have 10 there. And so then step three is that if step two is less than or equal to step one, the second safe harbor does not apply. That's not the case here. Step two is greater than step one. So if it's greater than step one, we go to step four, which is then we calculate the total FTEs as of the earlier of 12/31/20 or the date that the forgiveness application is submitted. And so as long as your FTEs as of the date the forgiveness application is submitted or by 12/31/20, as long as that's greater than your FTEs as of 2/15/10, then you meet the safe harbor requirement and you will not have an FTE reduction to your forgiveness.
So back to like the strategy, if you're toying with, when to file your application and what the future is looking like, if you need to hire some additional people anyway, and you're going to be, penalized or have this reduction because of FTE, maybe it makes sense to hire those people a few weeks early. Or if you do anticipate layoffs in the near future, wait until after you file your application in order to make those layoffs. So these are, this webinar really is just making sure you guys are aware of these decisions. And so you don't go make a decision about someone's pay or letting go of someone or hiring someone without knowing the consequences of how it may affect your forgiveness calc.
Yeah, that's a good point. We know that there are clients out there who are concerned about their operating environment. They may be running out through week 10 or week 12, and then are planning on applying for forgiveness. Just remember, you're going to have a little bit of a lag time between the date you use your PPP funds up and the date you can actually get everything together and get your application filed. And then with your lender, you don't want to go, reduce FTEs or make a decision in that interim period before you file that then triggers one of these, that then triggers a reduction for you.
Yeah, exactly. The point is to obviously maximize. This again was intended to keep people working and intended to keep paychecks in people's pockets. And so in order to maximize your forgiveness, you just want to think about some of these things. Glenn, anything else from you?
No, y'all covered it.
All right, well, I'm sure all of you know that over the weekend, the treasury.gov website crashed and it was MIA for a couple days, and all of us lost a bit of hair and had a small panic attack. But not to worry, it's back up now, so we were able to get that information in this webinar for you. So there are two forms, and you can find them on treasury.gov. They're both available to you to download there. Your banks may have also portals for you to download them as well, but we use treasury.gov as our main resource for this stuff. So there are two different types of forms. We've just talked about them briefly today. We're going to get into them a little bit more. One's the short form, one's the long form. So the short form is, for the sake of the webinar, that's the easy form, and then the long form is not the easy form. So,
Yeah.
what do you?
Suzanne, so before we begin that, I think these are my slides, aren't they? Before we begin that, I'd like everyone to just kind of close their eyes for like 3 seconds, take a breath, and say, I really need a good accountant for this. Because we said the same things. I mean, this is, some of these calculations and some of these safe harbors and how they interact with each other can be very, very different and difficult. And so, we're trying to give you a high level approach to these forms and to these calculations, but certainly, once you get into it and realize that, the convoluted interactions with all of these different sections, it really can be quite complicated, especially if you're a larger company. So the short form eligibility, there's some easy answers to this, and then there's some more difficult answers to this, and whether you're eligible to file this easy form. And so if you're an independent contractor, you file a Schedule C and you don't have any other employees, then you can file this form. It's a no-brainer. This is an easy one. You're not really worried about, FTE reductions. You don't have to worry about salary reductions. You don't have to worry about any of that. Basically, you're a formula, and so you can fill this short form out and you can move on. So that's really easy. So let's go to the next slide. So here's where option 2 and option 3 can really kind of come into play in what, the short form versus the long form. And so these terms that they're using here, really we've dived deep into these terms to make sure that we understand what they mean and to be able to convey them to you. So this is right out of the instructions. And so this is option 2. And so, if you did not reduce your salaries or wages, your annual or hourly wages for any employee by more than 25% during either your covered period or alternative covered payroll period, compared to January 1st through March 31st of this year, then you're okay on this part. Now, in parentheses here, it says, for the purpose of the statement, employees mean only employees that did not receive during any single period during 2019. So I really want to reiterate this: during any single period. Wages or salaries at an annualized rate of pay in the amount of $100,000, okay? So I'll give you a little bit of an example here. If you're getting paid, if you're paying an employee $60,000 a year, okay? Well, clearly, if you're paying them over, 52 or 26 periods or however you're paying them, okay, they're not having an annualized rate of pay of more than $100,000. Well, a 2-week pay period for someone that's averaging $100,000 is like $3,800. But if you gave this $60,000 employee a $5,000 bonus at the end of the year, then for that purpose, for what we believe and how we read it, that's a single pay period that he has an annual rate of greater than $100,000. So you have to look at, you know, each pay period and what you pay people. So if you got people on commissions, if you got, you know, different things, you've got to look at those types of things to see who qualifies for this 25% reduction. Okay. The next piece is, okay, this is an and, all right. So first of all, haven't reduced anybody by more than 25%. And you did not reduce the number of employees or the average paid hours of employees. And this is talking about the FTEs, okay, between January 1st and the covered period. Okay, so you can ignore individuals that you tried to rehire. You can ignore the borrowers unable to hire similarly qualified employees, okay, for unfilled positions. And then the last one is ignore reductions in employees' hours if you offer to restore those hours and they refuse. Okay, so these are the things that are out of your control, so to speak, and they're giving you this, you know, safe harbor, so to speak, of, hey, if you only had individuals that, you know, you couldn't replace or they refused to come back to work or whatever, under these circumstances, and you didn't reduce anybody by more than 25%, then you're good. You can file the short form.
Yeah,
okay?
just something to add here. The second, the and part about if you're going to exclude people that you tried to rehire, or if you tried to hire people and they declined. We'll get into documentation in a few minutes, but if you don't have that documentation, we strongly recommend that you pretend that didn't happen. So we don't want you to get stuck filing the easy form and then having to prove some things that you aren't able to prove. So we're getting into the documentation requirements in a bit, but just keep that in mind that if you don't feel you're able to prove this with paper support, it's probably best to say that this is not, you can't check this box.
Yeah, and that's really important, because some of this guidance about documentation and about employees refusing to come back to work, because, you know, some employees were making, you know, more on unemployment with that $600 kicker than they would have coming back to work for you. And, you know, certainly there are consequences to refusing a job for unemployment benefits. But if you do not have that documented, that you offered them a job, they refused it in writing, then you cannot use this. That is not, there's no other, you have to have it in writing. And it's very clear that the guidance is very clear about that. So anytime you talk about rehiring someone that you could not, and then also, you know, if you can't hire qualified people, you have to keep keep resumes of people that you did get, you know, resumes for. If you're trying to hire for a particular position that needs certain qualifications, you know, you need to make sure that you hit those documentation requirements. Like I said, we'll go over those a little bit later. So this is option number 3 for short form eligibility. The top paragraph is exactly the same. So don't reduce more than 25%, you know, for those people who had an annualized pay rate over 100,000. So here is the and that gets us to, you know, something of more what we call the get out of jail free card. I think, Andrew, that's how you put it.
Yeah.
Although I hate the game of Monopoly, it takes way too long to decide, you know, a winner. But anyway, so you have this unable to operate during the covered period at the same business level, and so as you were before February 15th. Okay, so these dates are really important. So due to compliance with requirements issued between March 1st and December 31st. So these are, you know, the dates that obviously these are all, you know, done by, and the Secretary of Health and Human Services, Director of Centers of Disease Control and Prevention, and and OSHA. So if you can't comply with these requirements for standards of sanitation, social distancing, you know, safety requirements, things like that, then and you didn't reduce anybody's salaries by more than 25%, then you can file this short form as well. Once again, the documentation supporting all of those decisions and whatnot, we'll get into that a little bit later.
Yeah, Glenn, I mean, and Suzanne, the way I always like to think about this is that essentially, if you meet the safe harbor requirements that we were talking about earlier, if you fundamentally, if you meet those, you didn't reduce salaries or wages, and you either fall into this bucket that you had to shut down because of an ordinance or law or governmental action, or you didn't reduce your FTE count, you basically get the easy form. If you don't meet those criteria, you're back over in the long form.
Yeah, and the easy form is really easy. So here's a look at it. It's got some questions and things like that to answer as well, but from a calculation standpoint, they've kept it pretty rudimentary. So line one is all your payroll costs, which include your health insurance, your retirement funding, all those type of things. You've got your mortgage interest payments, your lease payments, and then your business utility payments. Obviously, once again, documentation of all these things is still required, and we'll talk about that. And then you have one test to go through, and this is the 60% test for payroll costs. So line one, add the amounts of line 1, 2, 3, and 4, your PPP loan amount. You divide that, your payroll costs, divide line one by 60%, and you get to your number, and if it's greater than 60%, then you're good. So if line one is greater than 60% of your total loan, then you're good to go, and your forgiveness amount should be the full amount. So it's just when that payroll cost doesn't comply with that 60%, then you might have a reduction. So fairly simple and straightforward. The long form is not as complicated, or is not as easy. It's a little more complicated with different schedules and things like that, and we'll get into that next. And I think I'm turning it back over to Suzanne for that.
You are.
Right?
Real quick on the line 7, if you do in fact fail that test, that it's not an all or nothing deal. So just keep that in mind, that if you do, again, fail that, it doesn't mean you just don't get any forgiveness. It just means it may be decreased slightly. So as Glenn, sorry, Andrew?
I was just going to say too, the other thing that I know lots of folks are out there, we know lots of clients are anxious about it, and we're starting to get lots of questions about is, these are the official SBA forgiveness application forms. They're the ones that are on treasury.gov. That's the official governmental form. These forms, while they're useful and they're instructive, they're not necessarily the forms that you're actually going to fill out to apply for forgiveness, because your lender may have an electronic portal. They may have some kind of system that is going to feed these forms, but they may, we know that there are lenders out there that aren't going to be accepting paper forms at all. You're going to have to do it electronically through their portal. So just keep that in mind as well. Anyway, I'm sorry, Suzanne.
So I know you guys were all excited when Glenn said we're going to talk about the long form next, because that's the really exciting form. So this is, what you will look like when you open up the long form. So as Glenn mentioned, it does have a Schedule A and some pretty complex calculations. And this is where we're going to throw in a plug for Saltmarsh. So if you do get a look at it and want to jump from the skyway, give us a call. We'd be glad to help. We've got a whole team of people that are up to speed on this and can help you. So shameless plug for our firm right here. We've been talking about a lot of documentation, and I'm not going to go through the documentation in significant detail here, because we can send you this list separately. Please email the PPP email address if you'd like this, but just high level, some of the things we've talked about today, these are the things that are going to be required if you are audited by the SBA. As Andrew mentioned, your bank or your lender may have additional requirements outside of this. This is SBA recommendation, and this is what's, out there in the instructions on treasury.gov, but your lender may ask for more. And so don't take this as, the final answer here on what's due. This is just, as of right now, this is what we understand from SBA that will be required. So again, communicate with your lender, find out if they need additional things. Some of the main, points here: bank account statements, tax forms filed during the period for your payroll taxes, canceled checks. If you don't get those, some people don't get canceled checks, that's fine. But account statements, anything to support that those checks were paid. So you can, like I said, email us if you'd like the long list of documentation here. Some of the non-payroll costs, so you'll need, copies of leases, copies of amortization schedules. You're going to need to be able to support with account statements that those payments again were made. Now, the one thing to note here is you need to go past the end of the covered period and prior to the covered period. So these types of expenses have to have existed in February of 2020. You can't just sign a lease on March 1st and count that rent. And so the documentation here is very specific that you need to prove that that lease or that mortgage or that utility agreement was in place in February of 2020. You didn't just sign it the day you got your PPP loan.
We think lease renewals, if they happened, during the period, we think that's fine. If it's a continuing lease, just, from that standpoint.
These are the ones we've touched on quite a bit today and want to make sure that everyone is aware of. These are not required to be submitted with your application, but they are required to be maintained. So if your lender asks for it, you will have them ready. If the SBA audits you, you will have them ready. So again, these are very in-depth. We've talked about them, but just to repeat, documentation, HR documents surrounding refusal to work, hirings, firings, the number of people that you've had, anything to support your salary, so payroll records, things like that. So some of these aren't, again, required to be submitted, but you need to have them ready. Anything supporting, we talked about the inability to operate at full capacity. So the government's orders, if you've gotten any letters from OSHA, if you have any county specific requirements or state requirements that have prevented you from being open, you've got to keep copies of all of those to prove, hey, I was affected, by this. So we do have a couple minutes. Sorry, go ahead.
I would just throw out, do things like, get on the governor's website, print out copies, not print out, but save copies of his executive orders. Go to your local, if you're in Orange or Hillsborough or Duval or, Miami-Dade, go ahead and while they're still fresh, while you still remember what they are, go ahead and go grab copies of those, stick them in your file so that you'll have them now.
And maybe you could fax them.
That's right.
After you print them. Print them and fax them to somebody. So there is one FAQ that I wanted to get to because we did have quite a few of our registrants ask about what are the limits on owner or self-employed comp. So Glenn, what do you think about that?
Yeah, so the new guidance has been pretty specific on this. So depending on whether you have an 8-week period or a 24-week period, if you have an 8-week period, so for owner comp, you're limited to basically 8/52 of their 2019 payroll. So, if they made $52,000 last year, then it's limited to $8,000. Or 15,385, which is the 100,000 divided by 8/52. So if you made over 100,000, you're limited to 15,385. If you choose the 24-week period, now it's a little different. Now it's the lesser of 2.5/12. So it's not 10/52, it is 2.5/12 of your 2019 payroll. So if you made $12,000 last year, you're limited to $2,500. If you made over 100,000, you're limited to $20,833. And that number, that $20,833, has come up basically because that's what the loan was based off of. Now, this is only for owners, okay, and self-employed, only for owners. You can pay other individuals more during that 24-week period, but that has other consequences to it. It could cause you to have FTE problems or something like that. So now what applies? All right, so let's talk about the different types of ownership you have here. S Corp owners, okay? It applies to them, but you do not add health insurance and you do not add retirement benefits to this 15,385. For C Corp owners, you can add it to the 15,385 or the 2833. You can add the health insurance, you can add retirement benefits. Now here's one that it was brand new for partners. Okay, if you're in a partnership, LLC, multi-member, if you're filing as a partnership, you do not add health insurance or retirement benefits. And your cap is at the 2019 income times 92.35%. And this kind of comes off of the 1040 self-employment calculation form. So for example, if you are a partner and you had $100,000 last year, you are not capped at $20,833 or $15,385, because that rule that applies to you is not $100,000, it's $92,350. So you've got a different number that you have to calculate from, and it's not just, you know, cut and dry as far as what the S Corp and C Corp owners on their W-2 wages. And then finally, the self-employeds, you don't add back health insurance or retirement benefits to this. It's, you know, it's basically that line 19 of your Schedule C, 850 seconds, you know, or 2.5/12, whatever pay period is, to maximize your benefit of your loan. So hopefully that clarifies some of those questions a lot of people have, especially with the different entities and the C Corp owners and things like that. But these are very clear now in the statutes and in the instructions. And I think with that, we are out of time. I'm going to turn it back over to Jamie.
So Jamie, you're going to
close it out.
Here.
Yes, can you guys hear me?
Yes.
Good. Thank you to everyone that has shared questions. We've gotten several questions during the presentation, but in the interest of time, we'll hang on to those and follow up with you guys afterward. If we can move to our last slide, I think we do have some information. We've covered a lot up to this point. We know that you have questions. We're happy to help you with those, but keep us in mind if you do need more assistance processing your loan and that forgiveness application. Keep us in mind. We've got a great team that's focused on this. As Suzanne mentioned, they're almost dedicated to really keeping up with this information and helping our clients and friends navigate. So don't hesitate to reach out to us. That email is ppp@saltmarshcpa.com. We will keep you guys informed on upcoming webinars. I don't feel like this is probably going to be our last. So please stay tuned for that information. You'll get our program materials tomorrow. Let us know if you have any questions offline, and we're happy to help. Thank you all for joining us, and we hope you have a great long holiday weekend.
Thank you, everyone.
Thanks, everybody.